Hello there, ladies and gentlemen. Karaoke Andi here with part 4 of the beginner series, From Curious to Confident. And today is the big one. We're talking about candlesticks, market structure, time frames. We've got a lot to cover, so let's better get to it. Now, important disclaimer, everything here is for education only. I'm not your financial advisor. I'm a trader showing how I handle risk. Trading involves real money and real loss potential. Always make your own decisions and never risk money you can't afford to lose. Today's topics, as I said, a lot to cover. Different charts, different purposes. Most traders look at candlestick charts, so we'll show you a quick overview about that. Then the next chapter will be about candlesticks. Then we will cover basic market structure, and then I will talk a little bit about time frames. So let's start with charts, right? Traders use charts. So maybe one sentence before that. So you have probably heard of, or you basically see it all over the news, right? So there are some pundits who talk about a company making an acquisition. They're talking about new tax regimes, new laws that will be passed. They're talking about tariff wars and all of that stuff, right? How that will influence the market. They're talking about a weak dollar and strong gold. And all of that is called fundamental analysis, right? So you're basically looking at company reports, at economic reports, at the news, and from that you will derive how certain markets will be influenced by that. Yeah? We're not doing that here. What we are doing here is called technical analysis. So we will look at charts, and from that we will make our trading decisions, right? So just that very fundamental difference right off the bat. So let's switch back to the presentation. So if you Google a stock, and I just put here Apple stock into Google, you get presented with something like this. So Apple right now is trading at 269 US dollars and is slightly up for today. Pardon my German settings here, but you get the idea. And down here you're presented with a chart, a very basic chart. And the most basic chart of all of them is a line chart, right? It's basically two dimensions. You have time and you have price. Up here you can switch the time frame. It's important. This here is the daily chart. Then you can switch to 5 days, 1 month, 6 months, year to date, 1 year, 5 years, and max. So since this is set to 1 day, you have basically here 10 o'clock, 12 o'clock, 2 o'clock, 4 o'clock, and you have here how the stock is moving, time and price. It's the most simple chart. There are more chart types. If you open any kind of what we call a charting package, right? Tradingview.com, you can sign up for free. They have premium subscriptions. I'm not advocating that. I'm not an affiliate. Just take a look. There you can look at different types of charts. So there is your line chart, right? It's here. You get line with markers, you get step lines, you get areas, HLC, columns, high lows, volume footprint, time price opportunities, you get something that sounds Japanese and is Japanese. Heikin Ashi, Renko, line breaks, Kagi. You know, they all have their place. Some are very specific, some are very specialized, some are used by a lot of traders. But I believe the most common one, if you look at any educational video or at literature, trading manuals, the most commonly used one is a candlestick chart. So candles right here. Yeah. So I will show you that on a charting package. You see here, this is a chart of the DAX, right? And here I can switch. You see the different chart types. So it's a histogram. Here's a mountain. Here's your line chart. Here is Heikin Ashi, Kagi, Renko. Yeah. But I just want to focus on candlesticks. So this here is a chart of the DAX, the German stock index, right? And you also have here time and price. And you also have time periods. Down here I can switch. You have the daily, the weekly, the monthly, 8 hours, 6 hours, 4 hours, 2 hours, 1 hour, 30 minutes, 15 minutes, 10 minutes, 5 minutes, 3 minutes, 2 minutes. And the shortest that I have here in my charting package is the 1 minute chart, right? So what does that mean? Right now we have open a 5-minute chart. So each candle here represents an interval of 5 minutes. Yeah? You see this candle here, where my crosshair is, starts at 10:30 and ends at 10:35 on a 5-minute chart. On a 10-minute chart, yeah, the 10:30 candle would start at 10:30 and end at 10:40, because we're now on a 10-minute chart, right? So let's go back to the 5-minute. My candles here have numbers. They don't need to be there. It's just something that I switch on. The DAX opens at 9 a.m. Frankfurt time. Yeah, and from there I just number the odd candles here. So that's the first, that's the third, the fifth, and then I know, of course, that between 1 and 3 is the second, right? So they just have numbers. So don't worry about that. I can switch that off. So what else is here? You have bull bars where the market goes up, and you have bear bars where the market goes down. Bull bars where the market goes up, and bear bars where the market goes down. So my bull bars are blue and my bear bars are red. But that's just me, you know. Some people, they have green bull bars and red bear bars, and some even use black and white. Yeah? White for bull bars, black for bear bars. Why would you want to use black and white? Because you can, for example, then just print it out on a laser printer. Yeah. Why do I have blue and red? That's just personal preference. Yeah, it's just how I like it. You can switch it however you like. So what I don't want to get into are indicators. A lot of traders use indicators. I usually trade from a naked chart like that. But if you ever heard about moving averages, Bollinger Bands and whatever, that you find basically built in every charting package, in my charting package, it's under studies. Usually it's called indicators, right? So that gives you additional information. So here's a screenshot again of the DAX, German stock index. Let's wrap this up. You have different time intervals. This one is a 5-minute chart, so each candle represents a 5-minute interval. You have candles that indicate that the market goes up. They're called bull bars. You have candles that indicate that the market goes down. Those are bear bars. My bull bars are blue. My bear bars are red. But you can set it however you want. Okay? So that's it for this session. So now let's take a closer look at these mysterious candles, right? These mysterious candles. What are they all about? I will show you. No worries. Actually, don't want to get too deep into the history, but candlestick charts originated in 18th century Japan already, where they tried to track price movements of rice. Guess what? So let's bring back paint, but we don't assume we are rice traders here in feudal Japan. Let's assume we are in the early 20th century, before the age of computers. We were sitting there at the New York Stock Exchange, and we were just tracking the movement of a particular stock, General Electric or whatever. So, and we would just sit here. We have here 2 axes, time and price. And we would start, just at 9. Oh, let's make little bubbles here. Price is at 5. I went down. And here, I don't know, 9:30, the price was low, so it attracted new buyers. Buyers were stepping in. Price went up. Back to where we started. Now it's trading at 10, 12, 13. Here some would take profits, they would sell. So that means stock goes down a little bit. Find support here. And goes up. Yeah? So let's say that is it. And we would be interested in just simplifying what happened in between here in this interval. So we would just say, here, this is the interval we were looking at. From here, we are looking at this interval, right? From here to there. Whatever that is. Can be a whole day, can be a week, can be an hour, can be 5 minutes. So, and what we are doing is basically, we say, okay, so at the start of the interval, we trade it here, and we draw a line, right? So, and at the end of the interval, we trade it here. We draw another line. And in between, price was fluctuating. And then we just mark down the high and the low. So the high was here. We just mark it like so. And the low was here. And we mark it like so. So the tip of this, what we call a wick or a tail or a shadow, is lining up here with the highest price point in that interval, and the lower wick here is lining up with the lowest price point in this interval. And now you see what I was doing here, right? So This already. Wait a second. Oh. This already looks much like a candle, right? So just the body is a little broad. So why don't we make that body smaller? Yeah. And boom, we have now a candle that represents the price movement that happened inside here. So, and since price was going up in there, we can make that candle green. Yeah? Okay. So, how is that candlestick constructed? Yeah. So other than line charts, you get here a little bit more information, not just time and price. You know, it tells you a little bit more about what happened inside a given time interval. Yeah. So this is the anatomy of a candle. You have here what we call the body. Here you have an upper wick or a lower wick. Wicks are also called tails, sometimes shadows. It's all the same. Sometimes a candle doesn't have a lower wick, sometimes doesn't have an upper wick, sometimes no wick at all. And that all depends on how price moves in that interval, right? So, the body of the candle indicates where the interval starts and where it ends. So now it depends whether we have a bullish candle, then the candle closes higher than it opened. Yeah? So the open is here and the close is here. And on a bearish candle, price closed lower than where it opened. So it opened up here and closed there. And in between, you see the high and the low. The high and the low. Yeah. So to wrap this up, candle gives you more information than just time and price. It tells you what happens in the given time interval. You see the open, the close, the high and the low. Yeah. Bull bar closes higher than it opened. A bear bar closes lower than it opened. So you see that it's gotten a little bit darker. This is a longer video, so I have to record it in a couple of takes and then somehow pierce it together. I'm not good at video editing. Let's see. So, candlestick charts. Candlestick charts, yeah, and then there are candlestick patterns, right? Just Google that, do me a favor, put in there candlestick patterns, and then you find a lot of posters even that you can hang on the wall and print them out, and they have all fancy names and whatnot, and it can be quite overwhelming. So, let me tell you something. I never bothered to learn candlestick patterns, just a few basic ones. I studied price action really extensively, but I can tell you that to rely in your trading, when you put real money on the line, just on a sequence of 1, 2, 3, 4 candles, that's a little bit silly. In trading, we always look for confluence, like many things lining up. Later in the course, I will talk about basic market structure with you. I will tell you what support and resistance is. If you are at support, for example, and you assume that the market could bounce from there, and you have some candles or price action that is confirming that, that's called confluence, and then you have a much higher probability, right? So anyway, I will show you just my approach, how to look at that. And the goal is that I leave you at a place where you can, with confidence, then continue to study, right? Because trading is really, there's so many styles, so many ways to trade. This is a beginner course. I can only show you the basics, and from there you can evolve. And I will also leave you at the end of the course with some recommendations for books that I was reading, and that might be a good starting point for you, right? So don't bother with that. That alone will not save you, but I will show you the basics. Yeah? So I said to you that a candle, or sometimes we call it also a bar, yeah? So if somebody's talking about a bar or a candle, that's the same, right? That means the same, yeah? So, and I also told you there's tails or shadows or wicks, yeah? And sometimes there are no wicks, or very, very tiny small ones. If you encounter a bar or a candle that looks like that, that's called a marabuzo or maribozo. Marabuzo, I believe. Yeah. So that just means that in that interval, right, here in the bullish example, we started here and closed here. This didn't go higher in between, didn't go lower in between. What that means is just it went straight up. And here, the same way, just vice versa, it went straight down. Yeah. So every candle tells a story about bulls and bears, about buyers and sellers, right? So, and the story of a positive marabuzo is that bulls are strongly in control, buyers are in control. Yeah. From the open, the market rallied up and closed at the candle's high. I'm slowly now incorporating the correct terminology that you get used to, right? So, and vice versa here. Bears are in control. From the open of the candle, the market sold off and closed at its low. Yeah? And sometimes you have candles that don't have a discernible body. Yeah? That's what we call a doji. Yeah, and look, in a real life market environment, you know, those are textbook examples. You know, sometimes there is a little bit of body. Yeah, but this here is a doji, very small body, right? So, and if you have that body in the middle, yeah, what does that mean? Again, think in what buyers and sellers were doing. You know, it's a market. If you want to open a position, you know, if you want to buy, there needs to be somebody who is willing to sell to you, right? And vice versa. And both think it's a very good idea. You think it's a very good idea and you have your reasons to buy, and the other guy or computer, whoever is on the other side, takes the other side of the trade, thinks it's a very good idea to sell to you, right? So, and that's constantly happening. Hundreds of thousands of transactions at any given time in a liquid asset like a major stock index, right? So if you encounter a doji, what does that mean? You know, yeah, that means that we started here, yeah, and buyers pushed the market all the way up, and sellers tried to push the market down, right? Tried, you know what I mean? So let's fix that. Yeah. All the way up, sellers all the way down, and they ended up where they started. And that means this is indecisiveness, or neutral. So this is a very strong bullish example, a very strong bearish example. This is a neutral example, where the buyers and sellers decided for once, okay, this equilibrium, this is a price where we like to stay for the time being. The time being, this interval, right? It's neutral. So then you have these examples, a long tail and a small body on top or at the bottom. There can be a little bit of tail or no tail at all. And this is what we call a hammer bar. And this is an inverted hammer. Sometimes it's called a pin bar. This is called a hanging man. Sometimes they call it a shooting star. It's all the same, right? So again, in terms of buyers and sellers, in terms of the dance, look at the bullish hammer bar. We have no or very short upper wick, a small body, a long lower tail. And the tail should be at least twice the size of the body. So sellers, what did they try? We remember a bull bar starts here, right? So they pushed the market all the way down, but then buyers stepped in, and pushed it back up and even higher, and we closed at its high, right? And vice versa for the bearish hammer or the inverted hammer here, right? So started here, right? And then buyers tried to push the market up till here, and then the sellers gained control again and sold off the market, and the candle closed near its low, right? So these here are extreme examples. Now with a very tiny body here, only wick. It's sometimes called in the literature dragonfly and doji, but it's to me it's just an extreme example of a hammer bar. So oftentimes when you see something like that on a chart, that indicates a reversal, a trend reversal. And I will show you that the markets doesn't move in a straight line. It moves in what we call swings. It looks like waves, up and down and up and down. Swing high, swing low, swing high, swing low. That's how the market moves. You see that here. So when I took that screenshot, and I was 3 p.m. of the DAX, and I didn't need to scroll back much. You see here, I just scrolled back a couple of hours, and I saw here 2 perfect hammer bars, or inverted hammers. And really the color does not matter if that's if you look at it like a reversal pattern. But you see the market went up here, then came that hammer, that inverted hammer, and then it went down again. Same here, went up, there was that hammer, then it went down again, right? So again, a hammer bar can indicate a trend reversal, right? For that, the color of the body is immaterial. You see this one here is blue. It doesn't matter. But I also said that traders don't usually rely on just a single bar or a couple of bars to take a position, right? But I need to also show you some examples. So all you need to know for now, because I haven't talked about market structure yet, is you can see here it went up. You see here, that's the price axis. Here's the time axis, 5-minute chart. Every candle is 5 minutes. We went up here, hammer bar, or went down. Then we moved here somewhat sideways, push up again, hammer bar, and we got back down. Yeah. Look here. Here's even one more. Yeah. So, is this here a bullish example maybe? Huh? There's one candle in between. It's not a text picture perfect example, but the market will not always give you picture perfect examples. Look, here's even more. Anyway, yeah. Inverted hammer bars. So let's talk about, that was a single bar reversal. Now let's talk about 2-bar reversal patterns. Yeah? And one here is the engulfing pattern. So now I see that I'm in the way. So you see, what does that mean? You see that the body of that second bar here engulfs the body of the prior bar. Yeah. So that just means that the body is just wrapping around, engulfing the body of the previous bar, right? So, and that also can indicate a reversal. Yeah. Reversal just means it went up and then it goes down, or it went down and then it goes up, right? So in this case, we have a bull bar and a bear bar whose body engulfs the body of the bull bar. Yeah. So in this case, the size and position of the wicks are immaterial. They don't matter. Yeah. But what matters is where the candle closes. You know, when I look at the chart, I pay close attention to where a candle closes, right? So, you see, this is what we call a downtrend. We have a series of bear bars. Yeah? And to me, the close, which is indicated here at that shoulder here, yeah? I pay close attention if I get a close below the low of the prior bar, close below the low of a prior bar, to discern whether we are still in a downtrend in this example. Because this is now hindsight trading, right? But when the market is open and you don't see the candles that are, you know, right from the current one, right? Then you have to make an educated guess. So, and here you see that the close is below the body of the previous candle. Yeah. So what that means is, again, in the stories of bulls and bears, the bulls lost control after sellers stepped in. You know, look, it went first up, but then sellers stepped in and moved it all the way down and closed below the body of the prior bar. So, and again, that's the same 5-minute chart at, you know, 3 o'clock. This just, you know, didn't need to look far left for that. Here's a perfect example. So here, bar 28, I told you my bars have numbers, yeah, or my candles. See, bar 28, the body engulfs the body of the previous bar, yeah, and my bull bars are blue. In the textbooks, they're usually green or white. So, and you see here, we're going up, engulfing pattern, and then it goes down. Yeah. So again, I'm not saying that I would take a position just because I see one candle engulfs the other. Yeah. But with a little bit of confirmation, confluence with other signals, I might take that trade. It gives me a little bit more confidence. So, and this here is the bullish example, right? So here we first have a bear bar, and then we have a bull bar whose body engulfs the body of the previous bar, right? So that's the same example, just for the bull case, right? So still the same chart. Here is 3. And here you see an engulfing bull bar whose body is engulfing the previous bar body. So we are closing above the previous bar body. And this is coincidence, but here is also, you see, a hammer bar. And now you have an idea of what I mean by confluence, right? So if I was just trading candlestick patterns, which I don't, actually not at all, but if I was trading candlestick patterns, you know, this would be confluence. You have a hammer bar here, which alone indicates a trend reversal. See, we are going down here. Yes, there's a pullback, but it's overall it's going down. And we print that hammer bar, and then we have an engulfing pattern. So, and at that close here, when that bar closes, you could buy the market on close, right? The moment that bar closes, it's from 12.35 to 12.40. So at 12.40, we would just press buy. Our stop loss below here, below the swing low. And we could get out here at what we call resistance, at the level of a previous high. That would be a good trade idea. We would have very little risk and a good risk to reward ratio. Okay. Last slide. This here is a fancy pattern. They call that evening star. This here is a reversal pattern. So first bulls were in control, and then you have here this big bear bar. So now time frame. Those are 3 bars on a 5-minute chart. If I go now on a 15-minute chart, every bar on a 15-minute chart is made out of 3 5-minute bars, right? 3 times 5 is 15. So, and if you take that together, this here, on a higher time frame, that would just merge. Here's the top. Here is the body. Here's the lower tail. That would merge to this inverted hammer or shooting star, whatever you might call that. So there you also see that the higher the time frame, the less details you see, the more abstract it gets, right? So the abstraction is higher on a higher time frame. Now on a lower time frame, you see more about what's going on. And every candle itself is, again, when we go back to this example, how it's created, it's an abstraction of all the time price points inside, right? So I will leave you with that, and we will continue with market structure. All right, market structure 101. The market, whatever that is, when people talk about the market, they actually mean the instrument that they are trading. You can trade everything that your broker permits you to trade. You have usually a plethora of instruments. It could be crypto, could be forex pairs, that can be stock indices. That's what I trade. Individual stocks, that can be commodities like oil or soybeans. That can be precious metals like gold, silver, or platinum. Yeah. So the market, or rather, let's say a market, never moves in a straight line. If it does so, yesterday was the FOMC release. That is usually when news come out, sometimes inflation numbers, things like that. Excuse me. And that can very rapidly move the market, but that's the exception. Then the market really goes down in a straight line or up in a straight line, right? So, but you can think of it in terms of energy depletion. Those moves cost a lot of energy, right? And it's just an image for you to remember, yeah? That energy is very quickly depleted. The market can't sustain such drastic moves. So the market moves most of the times in waves or staircase patterns, and we call that swings. So let's draw that here. So, like so, sideways, or up or down. So, and all these little tops and bottoms, we call them swings or tops and bottoms. And just relatively to where you look at them, they're either a swing high or a swing low. So this would be a swing high, this would be a swing low, swing high, swing low, swing high, swing low, swing high, swing high, swing low, swing high, swing low, swing low, swing high, swing low, swing high. Maybe, yeah, should be, didn't draw it nicely enough. So maybe like so. Okay, I get the point. Swing high, swing low, swing high, swing low. And those swings, they occur on all time frames, right? That's just what happens there is, it's a market. You want to buy something, somebody needs to sell it. So price goes up, and then some people, they made money now because price went up. So what are they going to do? They sell, and then the price drops, and the price drop again attracts buyers, who say, oh, that's cheap now, let's buy, and that again pushes price up, and that's how that happens. Thousands and thousands of transactions every second in liquid assets. Market, asset, instrument, all the same for the purpose of a beginner video, okay? So, the market can move up, down, or sideways. This is a DAX chart of today. So, red arrows, market goes down. You can clearly see that. Green arrows, market goes up. and then it can also move sideways. We call that a trading range, or simply a range, or we say the market moves range bound or sideways. It's all the same. If the market moves up or down, we call that a trending market. If it goes up, it's a bull trend. If it goes down, it's a bear trend, right? So how can we discern technically what's the definition of an uptrend or a downtrend? The definition of an uptrend is that we make higher highs and higher lows. So what does that mean? Well, this is a swing high and this is a swing low. Now let's just call it high and low. It's the same, right? So high, low. And now it comes higher high, because that high is higher than the previous high. Lower high, sorry, let's start over. So high, low, higher high, because this high here is higher than that high. Higher low, because that low is higher than this low. Again, a higher high, because this high is higher than the previous high. And a higher low, because that low is higher than the previous low. Yeah? And that's how we define an uptrend. As long as we make higher highs and higher lows, we are in an uptrend. And that's important, because this is a textbook example drawn in Microsoft Paint. But real charts, they look like this, right? So, but you can see here, where's a bullish example, a low, a high, a higher low, higher high, higher low, definitely a higher high. And here the market broke structure. No, didn't. Because you see this low is still higher than that low. But here it definitely broke structure. And that was actually a fake down move. We will talk about that later, because it rallied. Yeah. So that's how it looks in real life. You have to train, with real charts to identify the swings, right? That's not so easy. Yeah. But look here, this is a downtrend. A downtrend is identified as lower highs and lower lows. So we have a low, we have a high. We have a lower low, because this low is lower than the previous low. The lower high, because this high is lower than the previous high. Lower high, lower low. Okay? Uptrend, downtrend. So, and when the market moves sideways or is range bound or in a trading range, it's all the same. Yeah? We have highs and lows that respect, they have a more or less clearly defined range top and range bottom, in which they zigzag. So, do we have that in the real market? That's the DAX chart of right now. Sure we have. Here's one. It's a trading range. Here's also one. See here. That's what I mean. More or less clearly defined. That's the real market. You see downtrend again, low, high, lower low, lower high, lower low, lower high, lower low. And then still a lower high, but we failed to make a lower low. Instead, we made a higher high. Yeah? That high is higher than that one, so we broke structure. But this was just what we call a pullback. Or the market pulls back a little bit, and then resumes. Yeah? Usually a trend has pullbacks in it. Sometimes we call that also legs. Let's see where we have a good example. Here's one, right? So it goes straight down and then it pulls back here and then makes a second leg down, pulls back and makes a third leg down. Yeah. So if you ever, I don't want to go too deep into that, but when somebody talks about legs, yeah, that's what that means, right? So here again, nice trading range. Actually, no, when you have something that looks like a trading range, but if you look more closely and see that you are making inside there higher highs and higher lows ever so slightly, yeah, that is a slightly upward tilted channel. Yeah, some would still call that a range, but you know, technically making higher highs and higher lows. Yeah, so real life examples. This would be slightly downward tilting a bear channel. Yeah, all right. Don't get confused. Just remember that here, higher highs, higher lows, uptrend, lower highs, lower lows, downtrend, trading range, sideways movement, more or less clearly discernible range top and range bottom. Yeah. So, and look at charts, practice to see, try to identify the swings, you know. Visual helpers. You saw me drawing a little bit, you know. I usually don't do that. I trade without any visual helpers. I sometimes draw a horizontal line to mark old highs and lows. We will talk about that. But diagonal lines I usually don't draw. But they can be a visual helper. They're sometimes called trend line. Yeah. So in this case, when you have more or less at one side something, the lower highs line up, you can draw here a trend line, and then you see, okay, it's going up. That's maybe something you can try, you know, here on the chart. Take your favorite charting package, TradingView, or what your broker delivers. They all have basic drawing tools in here. So for example, here we could connect there the lows, and you see here that would be a trend line. Also, if the top here could be connected somewhat in parallel, which they can. In this case, that would be a channel. Yeah. Here also, I drew a channel previously here without calling it a channel, or maybe I did. Anyway, those are visual helpers. So practice a little bit with the charts, identify swing highs, swing lows, draw trend lines, draw channels, and get a feeling for how the market moves, and that will give you a very good feeling for that, right? So let's look at more examples live. I guess we have done that. Let's move on. Now, the market respects old highs and lows. and we call that support and resistance. So what's the difference between support and resistance? I honestly, till this day, I still get confused. The way how I define it for the sake of a beginner video is that everything that is when price trades here, everything below is support, everything above would be resistance. Okay, so let's say we have something like this. So market in a bull trend, then reversed here, came back down. So, and now what happens from here? This is an old high. And the market tends to respect old highs. So this high here can become, doesn't need to be, but can become support. So I'm just drawing here a line to illustrate that. And then either it works or it doesn't work. We don't know what happens. But there is a probability that from here the market will continue up. You could trade that by buying here, put a sensible stop loss here, and try to target the highs here. So what also can happen is that support gets broken. So we are trading through here. So that would be a clean breakout. We call that a breakout. The market breaks through. And what also can happen is that old support becomes resistance. So what does that mean? That means we are breaking through there. So we're breaking through here. And then price comes a little bit up. And now old support becomes a resistance. And from here, we are trading further down. So if you see something like that, you could sell directly in anticipation of a breakout. Or you can wait for, sometimes they call it retest or confirmation. Wait for that to bounce off old support that became now resistance. And sell short here. Stop loss here. So that is an example of support. So now, what is resistance? Same thing. Market comes down, comes back up here. And here is that old high that the market might respect. Now we don't make it too complicated. I just draw here a resistance line and we just assume, yes, that works out and we are trading back down. If you want that other example where old resistance becomes support, okay, let's quickly do it. So we are breaking through. So either there is continuation, a clean breakout, or we're coming back and then old resistance becomes now support, and you have a little bit more confirmation if you want to go long. Once you see this, you buy here, stop loss here, market goes further up. All right. So Let's look at some charts together. Again, here is the trading range that we have seen on the live chart. You see down here, support, up here resistance. Yeah. And maybe you have heard somebody say buy low and sell high. Yeah. Don't you ever believe that buy low and sell high has probably destroyed more wealth than both world wars combined, right? Markets have inertia. Yeah? Don't try to pick tops or bottoms. Don't try to buy the low or sell the high. You know, you might get burned. The market has inertia. It might continue down or continue up, and you get stopped out unnecessarily. But yeah, in a trading range, when you have a more or less clearly defined range top and bottom, yeah, a strategy to trade that would be to always buy down here and to always sell up here. Yeah? And here you can see that old support can also be further away. Old resistance, sorry, that the bottoms here, the lows can be further away, and that is still respected. Also up here, resistance. Here's a little bit closer to each other. Here even closer. Yeah. See? All would be valid trades. So now let's look at reversal patterns. I will only show you two. And the first is a classic one. It's called a head and shoulders. How does that look? So market comes up, forms the left shoulder, goes further up, forms the head, and from there, that's the highest point. We go back down, form the next shoulder, the right shoulder, and from here we reverse. And I have drawn that intentionally because it's not always so symmetrical, right? Those are mere textbook examples. But now we can draw here something that's called the neckline. So we draw a line here, yeah, just connecting those two swing lows here. Yeah. And once we trade through there, we break through here, we could sell short because we expect now here the trend reversal. Uptrend reversed to a downtrend. So once the neckline is broken, we sell short. Stop loss would be, if you want to play it safe, above the head. If that is too far away from you, don't want such a large stop loss, you can put it also above the highest shoulder. But then, of course, there's a little bit higher risk for you to get stopped out. Even if it reverses, doesn't need to go straight down immediately. Sometimes it fluctuates around a little bit. Real life examples. So, an inverse head and shoulders is basically the reversal of a bear trend. Left shoulder, head, right shoulder. So now it's more symmetrical. Let's draw the neckline, which would be here. Actually here, yeah. So once we break the neckline, we can buy. Stop loss either here or alternatively on the lower shoulder, and then we're betting on a reversal. Yeah. So here in the DAX, yeah, that was the news release. Is it such a good example? Technically, yes. You have here a left shoulder, a head, even though the head is pretty down here, right shoulder, but you know, market came down, after that it went up, so you would have the neckline around here, yeah, would connect those 2 points here, so you would buy here, and then probably you would say stop loss here is a little bit too far away, so we put it rather here below the lowest shoulder. So your stop would be here. Yeah. And then you would target probably the highs here. Wouldn't exactly hit your target, but you probably would have the opportunity to move stop loss to break even. And what happened there? Market came back down. Yeah, and then you would have got stopped out for break even, which would be a scratch trade. Yeah, so that's how you would play it safely. So that's an example of an inverse head and shoulders. So look at the markets, pick any time frame and see if you can spot head and shoulders or inverse head and shoulders. So the last reversal pattern that I show you is a very common one. You see that all the time, and that's called simply a double top or a double bottom. Yeah? So here is a clearly defined double top. Price came down, came back up here. Yeah? So once you would touch that old high here, you would sell short, and it would take a while, and you would look for your profits. Down here, you see that old low here gets respected. Not this one, but this one. So this forms a double bottom here. So found support here. You would buy here, and you would have a nice trade. Also here, this is more like a micro double bottom. Variants of double bottoms can be higher high double tops, lower high double tops, lower low double bottoms, and higher low double bottoms. What that means is just simply that they don't need to align picture perfectly. Yeah? Sometimes that high is a little bit higher, sometimes it's a little bit lower, sometimes that low is a little bit lower or a little bit higher. So what does that mean? You can't always get a picture perfect entry. You have to see if you either want to jump on board a little earlier and place a large enough stop loss to accommodate maybe a lower low double bottom here. Yeah. So, but that's up to you how you want to trade it. Yeah. I believe we don't need to look at more charts. I think that's very apparent here. You see, for example, it's a slightly higher high double top here, a higher low double bottom here. They're everywhere. Sometimes they're far apart. Sometimes they're more like a micro double bottom, micro double top. It's basically the same story. Markets respect old highs and lows. They form support and resistance. Yeah. So I want to close with a tiny little bit of an advanced topic because I would be disingenuous when I say that the market would always move like a textbook. Can play often a lot of shenanigans, and you should at least be aware that they can be fake moves. So, and fake moves can have two variants, fake down or fake up. And for that to be a fake move, either buyers or sellers need to be trapped. So what does that mean? So that means, in this case, market was zigzagging here. Yeah. Made here a double top. Yeah. Came down here. So, and then it crushed through support. Yeah. And now we learned that old support becomes what? Resistance. But that didn't happen. The market traded back into the range and continued up. Yeah. So that means who is on the wrong side of the market? Who got trapped? The sellers. The sellers wanted to either sell the breakout directly, or they waited for touch here, old support that now became resistance. They placed their stop loss somewhere here, and they bet on continuation down, which didn't happen. They got stopped out. So when you see something like that, a way to trade it would be, obviously, you shouldn't have sold it. Otherwise, you would have gotten stopped out. You could reverse then, because you know you got played. But let's say you are just sitting there patiently and waited. So once we pushed through resistance here, we would buy in anticipation of the up move to continue. Stop loss below the swing low. Yeah. Okay. Here is the other example, fake up. Yeah. So it faked an up movement, and now the buyers got trapped. Again, buyers got trapped who took the breakout here directly, who hoped for a clean breakout here and continuation. Also those who thought that old resistance became now support and maybe bought here. In any case, buyers would have placed their stop loss somewhere here, right, inside the range, and then as the market traded back into the range, they got stopped out. So, and that is your chance to sell short. Place your stop loss above the swing high here and hope for continuation, targeting maybe here the lows again, since this is clearly in the context of a trading range. All right, so that concludes the how did we call it, market structure 101. So we are talking about how the market moves, rarely in a straight line, more often in swings, swings high, swing lows. Market can move up, down, or sideways. We talked about how to discern uptrends, higher highs and higher lows, downtrends, lower highs and lower lows, and sideways movements. Trading ranges have a more or less defined range, top or bottom. You can visualize that with channels and trend lines. We learned that the market respects old highs and lows. We call that support and resistance. Yeah. And we were talking about reversal patterns, head and shoulders, and double tops and double bottoms, and fake moves. So that concludes part 4 of the series. Thank you very much for watching. See you in the exchange. Karaoke Andi out.